So let's dig right into 2023. And when it comes to the economy, unfortunately, we are going to be paying that price of the aggressive central bank tightening that we saw last year. While the economy was relatively resilient in the second half of last year, we're starting to see many dominoes of the economy fall in the past couple months. And when you look at this chart, it's showing you that the estimates for GDP for the first half of 2023 are pretty dismal, basically flat to negative. So the risk of a recession in the first half of this year is pretty high. The biggest concern we have from the economic standpoint is the consumer. The consumer has been resilient in the face of rising interest rates and multi-decade high inflation. But when you look at the number of savings that they have, not only has the personal savings rate fallen to the lowest level we've seen since 2005, but they're taking out credit card debt at a double-digit annual pace to fund just everyday necessities. And when you look at this chart, we looked at the total number of savings deposits in banks. And you can see the big spike that we saw during the pandemic. Well, if consumers keep depleting that savings the way that they are, they will be back to pre-pandemic levels on a savings level in the first quarter of this year. That leaves them very little spending power going into 2023. The manufacturing side is now also catching up. We're seeing manufacturing fall into contraction territory, not just here, but globally. You can see in this table that this is a global issue from a manufacturing standpoint. Secondly, the service sector, which is where we spend in the U.S. the majority of our money, that now is in contraction territory. That was actually a bright spot during 2022. The biggest risks we have going into the year continue to be inflation and have we truly reached the peak in inflation? And then also the labor market resiliency, because that has an impact on inflation. We do think that we've reached peak inflation, and we will see inflation gradually come down through this year, but we don't expect by the end of this year to be looking at inflation in a 1% to 2% level. Instead, we think maybe a 3% to 4% level at the end of this year. That still is higher than what we're accustomed to. The labor market, while it's been very resilient, we are starting to see layoffs from some of the bigger companies, but we still do have job postings that are sitting there at near a record high and more job postings than we have unemployed. At the same time, initial jobless claims are extremely low. So in summary, we do believe that the first half is going to be a challenging period for the U.S. economy. But when we go into the second half of this year, keep in mind, not only did we mention the labor market still remains strong, even with an increase in the unemployment rate. Balance sheets on the household and the corporate level are stronger than they've ever been coming into a prior recession. And then even though the Fed is aggressively raising interest rates, we're still looking at real rates that are still significantly low. These are all of the things that we think are supportive of us seeing a short and shallow recession as opposed to a prolonged, more deep recession in 2023.